Welcome. We shall start this session from the previous session that we ended discussing about various sources of fund. Particularly, we will be talking about impact investors, incubator, accelerator. So, moving forward, here is an example of impact investor. Willgrow is an impact investor. They are a private organization, whereas they offer grant to a startup. If they are giving 1 crore rupees to some startup, a portion of that will be given as grant, meaning you do not have to return that money, and the other part will be converted into equity at a rate that will be determined based on the rate in the next round of investment. So much of leeway given to the startups, and here is the statistics of their impact that they have made to the society. It is commendable. Okay. Moving forward, we need to understand some of the these are some of the gist of the previous lectures. One is loans are primarily of two types. One is long term loan, that is given for creating long term asset like plant, machinery, even building. Short term loan is given for working capital, meaning to create assets like raw material stock, goods in process, and then finished goods inventory. Stocks and inventory, the two words are using interchangeably, and loans are secured by two kinds of securities, or securities can be of two kinds: primary, collateral. Primary securities are those assets which have been created by the loan itself, whereas collateral securities are securities that is offered to the creditors, the assets which are not created out of the loans that the creditors are giving. So, collateral are kind of securities that you create with your own money or somebody or some other creditors, but then you have the whole complete right and you offer that as a security. We have also learnt about seniority of loan, and it depends on seniority, meaning in the event of liquidation, who has the first priority to get the loan, get the money. So, that depends on whether the loan is secured by some security, primary or secondary, or it is subordinated, or it is kind of different other kinds of money, like preference capital comes later, equity shareholders come at the last. Now, before we go into accelerator, incubator, and other kinds of funding like crowdfunding, let us see the life cycle of a startup, early life cycle of a startup, and what kind of funds the startup should look forward to. At the beginning, at the idea stage, normally startups try to bootstrap, meaning that they try to manage their business with limited resources of their own, or they try to cut corners or cut cost through whatever means, like sharing office, using used machine instead of new machine, and then trying to get subsidy or grant from any source possible. As they move forward, they need more money because they are already out of money through bootstrapping, and then they look for friends and relatives to help them. So, with that money they kind of build the first prototype or maybe early prototypes, first, second, third, whatever, and then they gradually move forward, they get their product customer validated. At this point, they try to approach to incubators and accelerators. So, incubators actually give them some money, like at IIT Kharagpur we have STAPE IIT Kharagpur, who provides basic infrastructure like space, then a mentor, all utilities like water, electricity, internet, and then they also provide money, seed capital to the tune of 10 lakhs to 25 lakhs, depending on the kind of business that you are in and the kind of requirement of fund you have. So, you get access to that kind of money, and then you do not have to spend a lot of money for space and other things, and you have access to the whole ecosystem, meaning you have other friends who are doing similar or different kind of businesses, but you can kind of share many things with them. Even you can share a clerical staff that perhaps is not fully engaged with somebody else. So, he can do some time sharing. As you move forward, your product gets, your prototype is validated by customer. Here comes angel investors. So, angel has a lot of money, and you can actually look for kind of a not so small, but not so big, medium kind of fund to angels, and angels are high net worth individuals. We are going to see that moving forward. Then as you move forward, you have customer validation, you start acquiring customers, your revenue increases, you are visible in the marketplace. Then comes venture capitals, early stage venture capitalists. It all depends on the risk appetite of the organization, of the investors. Angels are small investors. So, they can keep a close watch on the startups that they fund. So, they can take higher risk. So, it is always said that angels have high risk appetite, but it does not mean that they love risk. What they do is they can kind of alleviate risk, or they can manage risk, because they are very close to the startup that they fund, and they have expertise in that particular domain of the business that they fund. So, they have almost like they have proven expertise, proven skills in that particular business, which perhaps the founders do not have. Then comes mid and late stage VCs, whose risk appetite is even less, but their ticket size or check size is quite large. So, they do not invest in a small sizes of investment, they invest in large amount. So, because they invest in large size, they kind of do not want to increase the number, so that they can keep a close eye. Even they may be willing to keep a person in the board of the startup that they fund. Then comes strategic investors. Ultimately, when you see profit, you actually can think of borrowing money. So, then it comes about debt. So, you approach to the bank. Banks normally do not fund a startup at the beginning, because banks cannot keep their risk appetite is very less, and they always prefer that they would fund a profitable business. At the same time, they will not be able to mentor also. So, they have their own limitation for funding startups. So, eventually you raise money through public issue, and you give an exit strategy to all your investors. Now, even before we start investors funding and how the dilution happens and all that, we need to understand the equity structure of a company and what is holding, what holding means. So, you must understand the basics of it. Suppose this is a very small part of the balance sheet. At the top left corner, where you write equity and liabilities. So, the first item is equity capital, and that is normally we refer to as fully paid up equity capital. So, there are two kinds of, means in your books of accounts you will be writing authorized capital and paid up capital. Authorized capital is the portion, is the data that represents that you are authorized to raise this amount of capital. So, ROC, register of companies, register of company has to, or you have to get permission from register of company to issue fresh share. So, unless you are authorized to issue certain extent of equity, to certain extent or certain amount of equity, unless it is authorized by ROC, you will not be able to issue shares. Suppose your authorized capital is say 5 crore rupees, meaning that ROC has authorized you to raise money up to 5 crore rupees in terms of equity. Now, suppose you want to raise fresh equity say of another 5 crore. That means, taking the total equity to 10 crore, you have to take permission from ROC to raise money up to 10 crore. So, 10 crore is your authorized capital, whereas you have already issued shares to the extent of 5 crore. So, 5 crore is the paid up share, meaning your investor, meaning your founders and shareholders have already paid the money against these shares, and then that represents your equity capital, whatever has been paid, and you show it in the balance sheet, that is the amount of money you have received. So, that is for all practical purposes is the equity capital. Now, suppose you have 3 co-founders, your company has 3 co-founders. Co-founder A holds 0.2 million shares, meaning 20 lakh shares of rupees 10 each. That means, his holding in the company is 20 lakhs against 100 lakhs of shares, or maybe 1 crore rupees. So, he holds 20 lakh rupees, out of 1 crore he holds 20 lakh in terms of lakhs. Co-founder B holds 0.3 million shares. So, he holds 3 million equity, 3 million worth of equity in the company. Similarly, C holds 5 million worth of equity, 0.5 million shares of 10 each. So, 0.5 into 10 is 5 million, is 50 lakh. So, total share is 100 crore, sorry 100 lakhs means 1 crore means 10 million. So, out of 10 million you hold 1 million, your another friend 2 million, another friend 3 million, another friend 5 million. So, everything together is 10 million. Now, your percentage holding is the portion or the percentage of your equity holding. So, out of 10, A's holding is 20 million, 2 million. So, he is holding 20%. B holds 3 million shares, 3 million equity, 3 million rupees worth of equity. So, it is 30%. C holds 5 million worth of equity. So, he holds 50%. It is the percentage of the 10 million total equity capital. That is how the percentage is determined. So, look at the pie chart. So, A holds 20 lakhs rupees worth of equity. So, out of the 100 lakhs, so his holding is 20%, B is 30%, C is 50%. Now, suppose you invite an investor, he invests say 5 million rupees in the form of equity, and you issue shares at the rate of 10. So, his holding will be 0.5 million shares into rupees 10 each. So, his holding will become 5 million rupees or 50 lakh rupees. Now, the total equity capital has gone up from 10 million to 100. So, 15 million, from 10 million to 15 million, because your new investors has brought in 5 million. So, everything together, now your holding will change, because though you hold the same amount of shares, same number of shares and same amount, because you means suppose you are A. So, A holds 2.2 million shares of rupees 10 each. That means, A holds 2 million worth of shares, B holds 3 million worth of shares, C holds 5 million worth of shares, investors also hold 5 million worth of shares. Now, if all these will be divided by 15 million, unlike earlier case where it was divided by 10 million. So, your holding will change accordingly. So, that is how your holding gets diluted. Look at this, earlier A was holding 20%, now he holds only 13%, B was holding 30%, now it has gone down to 20%, C was holding 50%, now it has gone down to 33%. Investors invested 5 million and he got 33%. So, your holding is getting reduced with the new induction of equity, induction of investors. That is how we define dilution. What is dilution? Extent of dilution in a round of funding depends on valuation of your startup. The example that I gave here, there is no valuation issue, because you have issued the share at face value, meaning that 10 rupee share has been issued at 10 rupees. you have the option of issuing 10 rupee share at 15 rupees, 20 rupees or even 100 rupees or even 1000, 1 lakh rupees, depending on how you value your company. If you value your company greatly, then issue price will be much higher. So, one share will be issued at a higher price, whereas this was issued at 10 rupees because you are at a very much early stage and you do not see much value. So, it was issued at face value, but subsequently when you issue shares, it will pretty much depend on the valuation. As you move forward, as you gain traction, you acquire customer, etc., your valuation will move up and the risk perception of the investors also will go down. So, as the risk perception will go down, investors will be eager to invest in your company. So, because there will be a demand of your share, so investors will be willing to pay premium to get your equity. That is how it is all kind of value enhanced and you get premium price. At idea stage, success appears uncertain, value is very low. As you acquire customer validates your idea, your technology, your prototype, risk is kind of reduced. So, you are more and more on the path of success. So, that is how your dilution rate will gradually reduce, rate of dilution. At the early stage, somebody gave you 5 million rupees, he got 33% of your equity. But suppose you issue shares at 20 rupees, not 100 rupees. Let me go back to the slide. Suppose you would issue shares at 20 rupees, then you will not issue this investor 0.5 million shares, you will be issuing 0.25 million shares for bringing in 5 million rupees. So, in that case his shareholding will not be 33%, but it will be much less and holding of U3 will be much higher compared to what it is shown here. So, that is what is dilution, and one needs to understand dilution very clearly, otherwise the future discussion is going to be very difficult. So, this is in a nutshell. As you move forward with your prototyping and validation of your model, the risk keeps on reducing and your valuation goes up and you dilute less and less for similar amount of money or even more amount of money. This kind of call it infographics, this actually gives a very direct idea about dilution. Suppose you have a startup and you want to raise 1 million rupees from angel investor in exchange for equity, but at different stages. Not that you are raising money at every stage, or maybe hypothetically you can think of like this, that you have an angel and at every stage you are asking for $1 million and look at the valuation that moves up and how your dilution reduces. Suppose at idea stage you raise $1 million. So, your investor is going to tell you that I am not going to be happy unless I get 20% of your equity, because at idea stage the risk is high and there is no value visible. Then you move forward, you have initial prototype and it looks promising and your angel thinks that yes, we are moving forward and there is little bit of attraction. Then again you ask $1 million to him. Now, he will not insist on 20% equity, he will be happy with 10% equity. That makes a valuation of 10 million rupees of your startup. So, earlier your startup was valued 5 million rupees because he gave 1 million for 20%. Now, he is ready to give 1 million for 10%. So, valuation goes up to 10 million. In the next round, suppose there is a proof of concept. Now, your same angel will be willing to give you another million rupees even for 5% of equity, which means that valuation is 20 million. So, likewise it keeps on moving and your angel will be ready to give the same amount of 1 million rupees, but for a lesser and lesser holding of equity. So, when you go to market, your angel is ready to give you 1 million for 0.01% of the equity, meaning that your company is now valued 10,000 million rupees, meaning 1,000 crore rupees. That is how you need to understand that if you have the option of raising money at every point, it is always better to delay raising money, because if you could avoid raising money early stage, at the early stage, you could save 20% dilution, 20% of the equity would be with you rather than giving it to the investors. Similarly, means at the same place, where if you raise the same 1,000,000 rupees much later, your dilution would be much lower. So, it is always preferable that you raise money on a later stage, but then remember, if you do not have access to this 1,000,000 rupees, your pace of development, pace of maturity of your idea or of your business model will be hindered if you do not have the money. So, here is a kind of a compromise that you have to think whether I should raise, suppose at idea stage you have the option to raise only 0.5 million rupees. So, rather than giving 20% equity to the investor, you could afford to give only 10% for 0.5 million rupees, if provided that you could go to the next level of development, meaning you would be ready with a prototype with only 0.5 million. So, you have to make a compromise. You do not want to dilute 20% equity at the beginning only. Why not? Because you need to save equity to be given to the future investors, because you are going to need lot of money. Not that with this 1,000,000 rupees you are going to go to market and you can create lot of customer. Even customer acquisition is a huge costly affair. So, when you are just at the level of go to market, you may be requiring not just million rupees, but maybe a billion rupees. Then if you have already diluted maybe 50-60% of your equity, then there will be very less equity remaining with you, that you can give it to the investor and get such money. They are going to insist on a lot of tons of equity which you do not have. So, save the equity, at the same time have an open mind to raise money and dilute, so that your pace of development is sustained. So, ultimately your objective should be to continue or to retain or to grow in an accelerated pace, while saving the equity, means to the extent possible, optimum, think of the optimum. Otherwise, if you do not raise money because it is diluting, you may not be able to move forward, etc. So, dilution and speed of development are kind of a correlated, meaning that kind of compromise that you have to always do. Just showing it graphically. Suppose you are investing, and then suppose you decide that your angel should enter at a point where you have proof of concept and you are about to move up, meaning that you are going to have some revenue, etc. So, you may actually decide to do like that. You may postpone approaching to the angel or investors, but then if the kind of cash burn that you may have may actually, when you may not be able to follow the brown line, it may actually lead you to the red line. So, a sure shot death kind of a situation, because of delaying raising money. Whereas, suppose you raise money early on, and with that money your development pace is accelerated, and rather than moving downward to the death valley, you actually move forward and immediately you have kind of success. So, it is a compromise you have to take a call. This is the opportunity loss that you lose because of delaying the decision. So, delay and dilution is to be understood very clearly. Here the dilution is 40%, there the dilution is say 20%, but then with this saving of this 20% from 40 to 20, you actually may not save the company as a whole. So, you have to think that diluting 40%, if I can save the company, is the best option. When you can say that you are ready to raise money. So, dilution and pace of growth should be kept in mind to decide when to actually approach to the investors. Normally, when you have a promising concept validated by early customers, you are sure that additional fund can take you to the next phase, is the right time to approach to the investors. So, you try to bootstrap, cut corners, and then do whatever possible to move to the next round. just delay the process, but at the same time do not sacrifice on the level of on the speed of development. That should be the strategy for approaching to the investors. Normally, you can actually fund through debt, through equity, through preference shares. Like if you approach to an angel or say venture capitalist, they might tell you that okay, we may invest in convertible debt. What about convertible debt or say preference share? Now, you have to understand the distinction between debt, equity and preference share to be able to make a decision under this situation. So, with what are the features of equity capital? Then we will move to the debt. Equity shares come with a voting right, meaning that you make some kind of a resolution in annual general body meeting, or whenever you all the directors meet, you make a resolution that we are going to do this. Now, your investors, if they are investing in debt or preference share, they do not have voting right. So, they cannot vote you out. Your resolution will always be passed if the directors are in unison, and equity shareholders have this voting right, and whatever percentage of equity share they have, that is the percentage of their voting rights. So, if somebody is holding 51% of the equity, he has 51% voting right. So, in any kind of a resolution that you put forward, if that person is on your side or he himself makes the resolution, that is going to be passed because he has 51% of the votes. Percentage equity capital also determines the amount of dividend that ones get. If somebody has 20% equity and in a particular year you declare say 10 lakh rupees of dividend, so he or she gets pro rata dividend. If he or she holds 20%, so he or she gets 20% of the 1 lakh rupees of dividend that you declared. Of course, reserves and surplus belongs to the shareholders, but then this kind of proportional in case of liquidation, otherwise normally people do not talk about it. Now, about preference share capital, it has the features of both equity as well as debt, meaning that it has features of equity because you pay dividend against preference shareholders. It has structure of debt, it is repayable. Equity is never repayable, you do not repay equity. But remember, equity can be bought back, meaning that you can buy back equity at some times on rare cases, but it does happen every year. Some company or the other is buying back their equity capital. So, equity capital can go down in some circumstances. It is not always the case that it will always go up or it will remain constant, it can also go down. Reserves preference share. So, it has both debt and equity features. Then this is about equity, preference share capital, reserve surplus and equity share capital. Among liabilities, you have long term loan, short term loan and accounts payable. These are major items. For long term loan, that is given by banks and other financial institutions like IFC, it is given to procure long term or fixed assets like plant machinery. You have to repay this loan by installments, meaning that every month or every year or every half year or every quarter, depending on the stipulations, you have to pay certain sum of money to repay this loan. And this repayment period may be 3 years, maybe 5 years, maybe 6, 7 years, depending on your comfort level and bank's agreement. Suppose your cash flow indicates that you can repay the loan in 3 years, repayment period will be 3 years. Now, so long term loan is repayable by installments. Short term loan on the other hand is given just like that, meaning they do not stipulate a repayment period or repayment structure. This money, they say, the bank says that this money is repayable on demand, means whenever bank demands the money you have to repay. As long as the bank is not demanding, you do not have to repay this money. This is a kind of a revolving credit that you draw the money and you deposit, again you draw. So, as long as your limit, means to the extent you are allowed to draw, as long as you do not reach cross that level, you can always draw. So, there is no repayment structure for short term loan. Repayment structure is only for long term loan. Long term loan is to be repaid by installment. Similarly, accounts payable is definitely payable. Whenever you have bought raw material, you have to pay the money, you just defer the payment, that is it. Normally, investors prefer to invest either in preference shares or convertible debt. They do not want to invest directly into equity, unless there are a lot of visible values, because preference share can have the feature of debt, meaning that they may insist that you repay my money, I have given you as a loan, so repay the money. Similarly, debt, but if they invest in equity, nothing to be repaid unless you make profit, no dividend is paid against equity. So, that is the problem. Now, let us understand, because investors prefer preference share. What is the difference between preference share and common equity share? Equity share is common equity share. Say preference share. Preference share, just because it has some features of equity, you have to pay dividend. Normally, the dividend is fixed. At the time of raising the money, you tell the investors that I am going to pay you dividend at the rate of 5%. So, 5% is fixed, but then you do not have to pay 5% if you do not have the money, but then it will get accumulated. The unpaid dividend will be accumulated, and at some point of time, whenever you have the money, you have to pay all the unpaid dividend to preference shareholder. Whereas, for common equity share, dividend is the prerogative of the directors, board of directors. If they think that there is sufficient money, they will pay dividend. If they do not think, they will not pay. But then catch is that for preference capital, preference shareholders, dividend is fixed, 5% is 5%. If you agree of 10% is 10%, whereas for equity share you can pay 100% dividend if you have the money. So, that is the upside of equity share, downside of preference share. Then preference share may be converted into equity. Equity is already equity share. A company may buy back equity share, but that is normally not the regular case. Preference shareholders do not have voting right. This is another downside for preference share, whereas equity shares, common equity shareholders have voting rights proportional to their holding. In case of liquidation, suppose there is a bankruptcy or there is a court case, or you think of liquidating your company, go to Himalayas or for whatever reasons, then the preference shareholders will get the money first. If anything is left after payment of preference shareholder, your turn will come. That we have seen in the previous session, that first comes the secured creditors like banks, second is subordinated creditors, then trade creditors, then comes unsecured loans like public deposit or something, then comes preference shareholders, and if anything is left, then comes equity shareholders. What is the difference between debt and equity funding? Debt and equity in a nutshell. Normally for equity, suppose you hold the equity, exit is you as an investor, then your exit will be through IPO, whereas if you pay debt in terms of debt, then means if the company borrows money from you, they have to repay the money, whether there is money or not, they have to repay. If they cannot repay, you will sell the asset and get the money. Whereas, if you hold equity, if they cannot repay, you cannot really sell the company and get money, because it is your equity. Of course, unless the valuation is good, nothing can be realizable. From cost point of view, equity has no cost almost, unless you are paying dividend, there is no interest. All that it has is dilution. So, from founders perspective, if they give equity in exchange for money, they suffer dilution, but they do not have to pay interest, whereas for debt fund they have to pay interest. For equity funding, you get part ownership and voting right, whereas for debt the creditors get nothing like that, but that they may get security. Equity holders do not get any kind of security. They have first claim on the asset, because of the fact that they are lenders. So, their creditors and their lenders, if in the case of liquidation of the company, they have the first claim. Now, before we go to bootstrapping, we will take a break here and we will start all over again. So, thank you from this session.